Good morning, everybody. First of all, I would like to thank George, and I was going to try to figure out your last name, but I'm going to pass on that. So I'd like to thank George and Prem Watsa for the invitations to speak today. I owe a great deal to Benjamin Graham, so it's a real honor to be able to participate in this program. The title of our talk is The Importance of Getting the Worst Case Right. As you all know, and I'm sure you're familiar with this first quote, the function of the margin of safety is in essence that of rendering unnecessary an accurate estimate of the future. That was a famous quote by Graham. I know that all of you are familiar with this quote. One of the things you learn in life is that you learn certain principles in many different ways. But it isn't until you experience those principles that you develop a belief system that lets you act on that information. So having the knowledge without the experience sometimes doesn't give you that belief. But once you experience it, it becomes part of who you are. I was in the investment business 6 years before 1974, which means I rode through the entire bear market of 1968 to 74. If there's anything that'll teach you the value of investment is going through a bear market for about 6 years. Really interesting experience, and it gives you a greater appreciation of the principles that Graham taught. I was very fortunate after I started my business for about a year and a half. I was referred to a new client, and I was very excited about it because I didn't have many clients at that time, and it was very difficult to get clients in 1974. If you talk to anybody about investment, they just wanted to part ways with you because most people had experienced disastrous losses. So this lady was a unique challenge. She was 65 years old. She was losing her sight. She only had $60,000 of money, which is about $450,000 in today's value. Inflation was running 10 to 12%, and everybody was scared about stocks. Everybody was scared about bonds because both asset classes were down dramatically. And so we had two problems. Number one, she was 65 years old and she needed income. The second thing is she needed to grow the portfolio beyond the inflation rate, which was 12%, because she could probably live another 20 to 25 years. She actually lived 21 years. So I started with the formula, well, let's maybe put 25% in equities and 75% in bonds, and I ran out the numbers. That didn't work. Well, let's put 75% in bonds and 25% in equities. Back and forth, I tried all the different formulas. No matter which way I worked it, it just wasn't going to do, and I was really concerned about that. One of the things that I didn't realize is there was nothing wrong with the formulas. The problem is she didn't have enough money. And so as I thought about it, I asked the people to come back a couple of days later. I said, let me think about what to do so I could come up with an idea. Well, I was sitting at my desk, not even thinking about it, but after struggling for it with a couple of days, all of a sudden a thought came to me. I kept thinking, how do I get that extra margin of safety that will assure her a good return? I kept thinking about it. One day I was sitting at the desk, it popped in my head. What if I buy her stock at the worst possible case? In other words, you figure out the worst case and you only buy the stock at that time. And if you couldn't buy it, you'd be in cash and bonds. And if you could buy it, you would buy that stock. So I called the people back. They were very happy with that approach. It didn't tie me down to any formula of how much to invest. And all I promised them is I'm going to figure out the worst case. I'll only buy it if it's the worst case. If it's not, we'll put it in cash and bonds. So the idea was to let the market tell us how much to invest in it based on values. Not based on age, but based on values. And that seemed to satisfy both of them. So I'm going to show you a structure about our worst case. If you look at this structure here, you'll see how we determine a pricing structure. First of all, you got the private market value, which is about $36 in this case. You've got an intrinsic value of about $30. We have a buy point at $15. And then we have, based on our analysis, a projected worst case. Now, many people use many different approaches, and the most popular one is you figure out the intrinsic value and then you figure out your discount or your margin of safety, and you invest in that. Well, I wanted to go one step further than that because having gone through the '74 bear market, I knew that you could figure out the value of a stock, you could figure out what the value was, you could figure out a good return, and then when you buy it, it could go down 50%. So that margin of safety just wasn't adequate enough. So what I wanted to do was figure out not only what was a good return, but how can I figure out the worst case, which would include a bear market, a recession, or any particular distress in a particular company. Those lows and those studies became our worst case. And in Mrs. Welch's case, was her name, we bought it only in the worst case. Now, in the next chart, I'll show you a little bit about how we come to that conclusion. The first thing is, in this case, we would buy a stock at $15, it was worth $30. It had a worst case risk to $3, it had 15 to the upside, that gave us a 5-to-1. So you have 3 on the downside, 15 on the upside, you got 5-to-1. That means you got 20% risk on the downside and 100% over 3 to 5 years on the upside. Now, if you go a step further, this is one of the things that really makes a point to me, is that you drop the price only $1 to 14, you got $2 on the worst case risk, but you increase your upside by 16, so now the reward your risk goes from 5-to-1 to 8-to-1. I'm showing this to show you how important buying right is. Then you get to the percentage downside, it goes down from 20 to 14%. The upside goes to 114%. Now, if I drop down to the worst case, you can do the math on the other ones, you can see that theoretically there's very little risk. You've increased your upside to 18, and now you have a potential of 150% return on the same stock as opposed to 100% in the other one. The risk, of course, is that very few stocks get to that extreme point, and so the risk as you go below the buy point is you tend to miss them. But in her case, we were willing to do that because they didn't want to be in the market too much anyway. They were worried about the market and her condition of 65 and so forth would prevent that. So this helped us decide how much to put in the market, not by age or anything else, but just how much value. Now, I realize that this approach doesn't work with every company. It doesn't work necessarily with the spin-off because it's got no history. It doesn't work with companies that are completely different than they were 10 or 20 years ago. But if you take 20 or 30 companies and you do the worst case, I have very rarely seen, even in extreme markets, that every stock gets to the worst case at the same time. So it does give you a sense of protection. Now, this is what Benjamin Graham meant when he said price determines your return. As I showed you, if you buy it at $15, you got 100% upside. If you buy it at $12, you get 150% upside. The company hasn't changed, the management hasn't changed, nothing has changed except what you paid for that stock. So that's what he meant, that price determines your return. I have another saying that covers it. It says the Bible says that love covers a multitude of sins. In the stock market, price covers a multitude of mistakes. And since we're talking about love, the lower it goes, the more you should love it. Anyway, now about 9 months later, I was sitting in my office doing the performance reports. And at those days in '74, we didn't have computers, so they were all done by hand. So I was going through the portfolios, and then I got to Mrs. Welch's portfolio, and I was saying, geez, I don't think her portfolio report is going to be as good as the other ones. We had a rising market, fortunately. But we missed a number of stocks. And so I thought, well, we did the best we could, but I don't think her performance is going to be as good as the rest of the shop. Well, as I did the report, it turns out hers was the best in the shop. Admittedly, we didn't have many clients, but it was the best of the bunch. So I thought, that can't be. I missed a number of these stocks. So I went back, because this was by hand. I kept on checking it back. I said, no, there was no mistake. This was the reality of it. So then, naturally, the first thing I wanted to do is, how did that work? Well, if you look at the chart again, if you buy it at $12 and it goes to $30, you got 150%. If you start at 15, you got 100. But the most important thing I realized is if you buy it at $12, by the time it gets to $15, our clients who were in it at $15 were breaking even, but if she bought it at 12 and it went to 15, she had a 25% return, where the other ones were just getting started. So getting a 25% more return on every purchase you make is going to tend to make up for the ones that you've missed. So that is the reason that I feel buying it right is so crucial to anything you do, whatever perspective you have in investing, whatever it is that you buy, when you buy it at the right price, it makes all the difference, and it prevents the problem of having too much to do with the future. Now, out of that important lesson, there were several things that I learned from that. And by the way, the money lasted for 21 years. She was even, at the time she passed on, she was able to pass on money to her sons, so everything worked. And I think the only reason it worked with that little bit of money was because of the fact that during that period, from 75 to about 80, she was almost 92 to 95% invested. You would not normally do that with a woman in her position, but it was driven by the fact that the most important consideration was the valuation rather than the age. The important thing that I learned of that is you have to take the person's age into consideration, no question, and the condition. But a big part of that should also be how much value is it that you can buy. For example, you normally hear, well, if you have a young person, they're young, they got 40 years, you can fully invest them. I wouldn't invest somebody who's in an overvalued market 100% just because they got 40 years to make up the losses that you lose during a bear market. As we know from bear markets, they can take many times to recoup. And if you look at the tech bubble, you can see that that took almost 25 years to recoup your losses. So buying in an overvalued market just because you're young doesn't do the trick. Also, using the valuation approach to deciding how much to invest can also help you with your particular client. Now, we've talked a lot about the worst case, so let's take a look at how we define that. As you can see, there are many variables that people use. People use free cash flow, EBITDA, price to book, whatever. We list all of these multiples down. So we go through a company and we look at 20 or 30 years, the longer the better. And one of the things we find out is that certain multiples apply differently to different companies. So somebody might be used to using free cash flow, and obviously that's the ultimate thing you want in a company, but sometimes that may not be the best ratio to use because it doesn't define it necessarily. So what we do is we go over 20 or 30 years, we try to find as many things that can apply as a multiple. Price to book, EV to sales, price to free cash flow, whatever. But if you go over 20 or 30 years, you're going to see that there's only 2 or 3 of these type of varieties that are going to tell you what it is. So when you get into the situation, you pick the multiple that most represents it. And in those 20 or 30 years, you're going to have at least 2 or 3 bear markets. You're going to have a couple of recessions, 2 or 3 recessions. And then there's going to be a couple of times where the company stumbled a little bit and the market tends to push the price down. Now, one of the things that has really amazed me in studying worst cases is how amazing efficiently the market prices the stock at the extreme low point. That is amazing. We've seen companies, and I'm going to show you one over 27 years, that every time it got to 0.90% of book, that was the extreme bottom. So it is interesting to see how the price will go all over the place, but at the extremes, they get so valued that you get a good idea. It is. So we take those things, and then we take the 3 lowest years where we can apply those multiples to. So let's say you're talking about, just not that this is the best indicator, but just a simple one. Let's say the price drops 1 time book at one time. The other time it's 1.5 times book. The other time it's 1 time book. It could be 2 times book. So rather than taking the extreme, you don't want to do that because that increases your risk of missing the stock. It may be one extreme market. You take an average of 3 or 4 or those worst years. You take those multiples, you average them, and then you apply them to the current book. And so those are the things, and we're going to give you an actual example in a few minutes. But that's the idea, is you study the downside. And by the way, when you study the downside and you read the reports of why the stock went down and so forth, you get a better indication of the management. It gives you an indication of how they view things, how much they believe in what they're doing, and it gives you a lot of insights. Now, there's 2 more things that we need to cover before we get into finalizing the worst case. And those 2 things are, number 1, inflation, which has a dramatic effect on prices, and also commodity prices, if the company is involved in different types of commodities. Now, let's take a look at the inflation. Here's a chart that shows the different multiples on companies in different environment of inflation. Now, the interesting thing is we haven't had inflation to speak of for 22 years. The average inflation of the last 22 years is 1.7 or 1.8%. But over the longer term, it's more like 3.5 and higher. And I lived through the period where we had 12% inflation, and you can just imagine what happens to those multiples of those companies as the inflation goes up. Now, the first one I'm showing is the Value Line Index. That's a put out by Value Line Investment Service. The beautiful thing about it is it publishes it every week, so you get an update every week. You have 2 quarters going back and 2 quarters future, so it isn't all projection, it's a mix in between. It tends to be more reliable. They have 1,700 companies in the index instead of the 500 in the S&P, so you get a much better idea what the average stock is going for. Unless you have the big cap blue chips like the S&P doesn't really represent the average stock. I find that the Value Line is really about as good a proxy of any index I've seen for the general stocks. Most important, it's a median. And that is very important. I don't know why they don't publish median PEs on all of the indexes, because it tends to separate things. I've never really felt that average always tells you the true story. It's kind of like having your head in the freezer and the foot in the stove. You kind of got average body temperature, but I don't think you'd be very comfortable, and I don't think it would really show you what's going on. So I like the idea that they use median. So we use the median PE on the S&P as well as the Value Line. And you can see as you get to 2 or 3% inflation, that's kind of ideal for the big companies. You got a pretty strong economy, not enough inflation to hurt you, and you get a high multiple up into the 20s. But as the inflation goes up, the multiple on your average stocks goes down as you can run your figures down the page. And when you get to something over 3 to 4%, now you're going to get a tremendous contraction in the stocks. So as we're looking 3 to 5 and many years ahead, you got to ask yourself, what is the inflation environment going to be in that environment? If you're expecting a 20 PE on an S&P stock and you've got 4 or 5% inflation, you might have to adjust that multiple down to take into account that it might only be 13 or 14. If you get over 5%, you get 8 multiple, so we're coming down from 18 to 19 to 8 on the average stock, and you've got a PE of 9 on the S&P. If you go to the high inflation of the 70s, you had the PE of the value line of the average stock going down 4.8, whereas the PE on the S&P went down to 7. So inflation has to be part of the thinking of building a worst case, even though we don't see it right now. I am not predicting it. There's no way of predicting it. I have spent at least 30 years studying inflation, and I've never had any one indicator that would tell me that you can predict it, especially economists. Probably if I had to use 2 indicators that would give me the best shot, and it's not perfect, it would be the price of gold and it would be the commodity index. So when those start to firm and when they start to wake up, gold has always been a good hedge against inflation, and it might surprise some of you that when Nixon cut gold from the dollar, the appreciation from $35 to $40 to $12.50 where it is today, or $12.80, is about a 7 to 8% return. So over the long run, you get a good return, but it takes a lot of patience and so forth. If you don't invest in it, then you should follow it as a potential inflation indicator. Now, let's take a look at what happens with inflation. First of all, let me say one thing. I'm not predicting inflation. I have no way of knowing whether we're going to have it. But having seen what the government has done with creating the leveraged balance sheet of $4 trillion out of $800 billion, of having QE and have that money parked in the banks, leads me to believe that at some point, if we get into a financial crisis, they might not have shrunk their balance sheet enough, and they might have to use another QE, which eventually is going to show up in inflation. But there's no way I'm predicting it, nor do I have any methods of doing that. However, I can tell you one thing by the past, and let's study the past. In January of '73, we had 2.76 inflation. The multiple on the S&P was 18.9. 1 year later, 4.93% inflation, 12.4 PE. January '75, 11.5% inflation and a 7.8 PE. We're at about 1.8 to 2%. We don't know what's going to happen, but it's something that we want to keep in mind. So in looking at the worst case, look at the fact that how low these stocks can trade, try to get an idea of what is a reasonable inflation rate, and I would say that the history of inflation is about 3.5%, so we are obviously at the low end of it, and I wouldn't see, and it may be possible that it goes even lower if we have a recession in the meantime, but over long term, I think you'll see a little bit more than we've had in the past, and you want to think that through. Now, the last point that we do before the worst case is what happens if the companies are involved in commodity, or how does commodity prices affect the company? Well, we did an average study of the average metals, and that includes precious metals, silver, gold, platinum, palladium. They go down an average of, they go down a maximum of 63%. The average number of days is 389 days, which is about 1.5 years. The average decline is 37%, and so that takes care of the metals. If you go to energy, oil, natural gas, any of these energy products, they go down 73% maximum. It's been 3 times in the last 25, 30 years that oil has gone down as much as 73%, especially in the last cycle. The average time is about 184 days. That's 184 trading days. And the average decline is about 38%. If you go into the agriculture commodities, those are the least predictable because many of the markets are thin. But you can see that it is an average of about 65%. So taking into consideration the inflation and the commodities will help you formulate your idea just what your risk in the portfolio is. Now, one of my favorite quotation is by John Templeton. He says, always invest at maximum pessimism. Well, everybody knows that and everybody believes that. The only problem is it's very difficult to do. And first of all, how do you know when it's maximum pessimism? I can tell you going through the 74 bear market, when it was about halfway through, there was maximum pessimism. The only problem is it dropped another 25 or 30%. So I thought about, how do you measure that? Especially in a company whose earnings aren't straight line and whose earnings fluctuate around, like a cyclical company. Well, the earnings go all over the place, the cash flow goes all over the place, and the price goes all over the place. So how do you develop the confidence to be able to buy at maximum pessimism, and how do you see that? So here I'm going to show you a company that is the most difficult probably to figure out, because you can see that the book value has grown, not dramatically, but it's grown a decent 6%. The earnings in the last 10 years have grown about 8 to 10%. Book value, everything is done well, but it's cyclical. So we applied all the different ratios to it, and we found out that out of all the ratios, the only ones that were consistent is EV to sales, enterprise value to sales, and price to tangible book, because the earnings and the cash flow fluctuated. So that's what we do. So we look over this year and we say, okay, this is what the company's book value is going to grow, the tangible book value, and that's the one that we're going to rely on as the ultimate price to figure out the worst case. Then we'll take the normalized earnings, figure out PE on that, but this gets us to the worst case. Now look at the stock price. It's all over the worst case. If you were in one of those cycles that were down, you can look back in hindsight and say, oh yeah, here's the worst case, just the bottom of the stock. But when you're in there and you're going through it and you get all the noise and all the things that go with the worst case, you're not sure whether that's to do. So what we do is we superimpose the price on top of the earnings. On top of the book value. And you can see now that as you take the book value growth and now you look at the price, you can see that in the last 27 years, there has been times, 5 times to be exact, where you could have bought that stock at maximum pessimism. Maximum pessimism translated in this company is 0.9 times book. You can figure out where your buy point is going to be, and that gives you an entry point, and it gives you the confidence to think that you'll be able to do it. Now, here's the good news about maximum pessimism. That's another characteristic. The stock in maximum pessimism usually drops very dramatically. It's going down and dribbling down and dribbling down, but then it gets to the point where it just falls apart. It just goes way down. That's the good news. The good news on maximum pessimism is it goes down very dramatically, but it doesn't stay there very long. And in this example I just showed you, the big problem with waiting until the worst case, like we did in this lady, Mrs. Welch's account, is that sometimes you miss it. So what you do is you take the amount of time, each time it gets into the worst case, you say, how much time does it actually spend trading days? So in this particular example, you're trading it for 13 days. At the maximum pessimism, out of all the 5 times it hit there, it only stayed there in 13 days. So if you need to build a position, now you have to adjust your price up a little bit for maximum pessimism. You don't put the full position on, you just wait and average it down. Now when you move it up to the buy point is at 57 days. So that's why we use a price above the worst case of about 25%, because we find out if you wait to the worst case, if you want a bigger position, it may be harder to get. But if you start at the buy point, you have 57 days to accumulate your position, and then if it drops down further, you have another 13 days. Now, this is a smaller company. It's about $1 billion in sales, 28 million shares. But if you had a more liquid company, you could still measure how long it stays down, but you wouldn't have to worry so much about timing it. Now, here is the next chart, which shows you where this stock traded, not only in terms of its worst case. The yellow line is your worst case, 0.9 times book. The blue line is a intrinsic value, or what the company should be selling for most of the time. And you can see that that price moves quite a bit over. But if you buy it close to tangible book, you can see that this stock trades at 0.90 tangible book at the bottom, and it trades to 5, 6, and even 7 times book at the peaks. Now, the last peak is at about 5.5 times book. The stock is pricey right now. It's interesting that there are 4 buys on the company and 1 hold, and at every time you hit the tangible book, there's very few buys at all. So that gives you an indication also of maximum pessimism when you don't have anybody recommending the stock, and quite frankly, it would be very difficult to buy it after it's had that decline unless you feel that there's some way of figuring out what is the worst case. I don't have the time to go in why worst case is so great to determine, or why stocks don't go much below that, but it has to do with value. And I think basically the simple answer is that when a stock gets to that level, it is so attractive to people in the value community, it's so attractive to other corporations, that it's cheaper to buy the company than to create the company or create the sales by itself. Many times you can buy a company at worst case where it is as cheap as if what it would cost you to build a whole sales force and start the company and so forth. So I think the bottom of stocks is that point where the value is so great that it's so much cheaper to buy it at that level than to try to recreate it. And I remember when I first got into business, I was reading this article by Warren Buffett, and he was mentioning that he asked Ben Graham, why do markets always come back? And Graham thought for a minute, and he kind of shrugged his shoulders. He says, I don't know, but they always do. And I always thought, geez, there's got to be a better answer than that. Why do they always come back? Well, the simple answer is, like I just stated, if the company is so cheap that it's hard to resist, that you can't replace that company without that, then you're going to find people stepping in at that time, and that's when the stock starts to recover. Now, the last line in closing, I would like to make an analogy, which I always explain to people when I talk about buying at the worst case. So let's say we're in a building. We're at the 3rd floor, and we need to get to the other building, and there's a plankway. It's not a tightrope, but it's a pretty thin, narrow place, and you could walk across that and get to that building right away. That's one approach to get there. And when you get there, you still have the ability to go up 100%, because sometimes the stock goes to 6 times book. But if you use the value approach, you let the elevator take you downstairs. And what's the elevator? The elevator is the stock market. Once the market goes down in the stock, you take the elevator down to the 1st floor. Now you're on the worst case. You walk across the building. You let the elevator take you back up, and you're back on the 3rd floor. Now, the advantage to this person on the 1st floor is you can look at the person on the 3rd floor. If he's wrong, he's got a way down. If you're looking at the 1st floor and you fall down, there's probably not that much risk that you're going to go down. So let me close by saying this. When Ben Graham ended his career in 1972, he said, we were the richest country and the most powerful country in the world, but that we were dealing with all sorts of major problems. Because of my own experience in the 70s, I would add that one of those problems was an overvalued market. I believe today that we are in many similar areas in the time when Ben Graham retired. But here's what he said at that time, knowing that there were a lot of problems coming. He said, after studying for 57 years, there's some comfort to be gleaned from these last 57 years, and it's 100 years now since he was talking about 1914. Through all the vicissitudes and casualty, as earth-shaking as they were unforeseen, it remained true that sound investment principles produce generally sound results. We must act on the assumption that they will continue to do so. Of all the great principles that Ben Graham taught, I can't think of any that apply more to the economy and the market today, and that is the margin of safety. I hope that I have given you some thoughts that you can apply to your portfolio, or at the very least, refresh your memory of how important the margin of safety principle is in ensuring you have a decent return, but more importantly, also having you measure that return against the risk. Thank you very much.